Welcome to the Twomey Stock Market Report. I'm James Twomey, and today is Sunday, March 19th, 2023. Couple of quick developments in the marketplace this week. We saw basically a sideways move when it was all said and done. Increased volatility, of course, lots of dramatic changes in ups and downs from day to day. And overall, we're seeing the impacts of a couple of items. One is higher interest rates on the market and economy. We're seeing also how this long-term debt of bonds held to maturity near 0% are now starting to show problems in the credit, banking, and financial sector. It's all across the board, whether it's lending, real estate, banking, regional banks mostly, or high-tech sectors that are requiring infusion of capital. Money is slowing down, and that's affecting everything that's out there. And surprisingly enough, we have a real interesting development that's going on in the NASDAQ as we see prices start to rally once again. Year to date, the NASDAQ's up near 11% after a pullback to about 4 or 5, 6% level, which is very encouraging, especially with the developments. So let's do a couple of things. Let's scroll down here to the Twomey Stock Market Report. And you can easily get this by going to our website at TwomeyStocks.com. That's the number 2, mestocks.com. And on the front page, you'll see a link to the market report. You can pull that down, get the information, read it at your leisure. In addition to that, you can find our videos out there that with either market updates or key technical indicators that you want to watch throughout the week. And of course, the weekly market report is also, video report is also on our front web page. And you can easily sign up for trades and alerts that we supply to you real time, and also training videos by subscribing to our newsletter. With that said, CBOE numbers did ease a little bit. They backed down to 0.65 from 1.11 of last week. So the bearish sentiment is pulling back. That's kind of an interesting factor because we saw Friday's sell-off, and that didn't seem to affect the number of bears out there. But we'll see as this starts to develop. When I say this, the credit woes start to develop. But for now, that extreme bearish sentiment indicator is starting to wane, which can help markets. And you look at the market overall, it's kind of a sideways week anyways, even though there's high volatility in a lot of ranges. We look at our advanced decline chart for the New York Stock Exchange, high breadth of stocks. A lot of stocks participate in this chart. Gives us a good indicator. We like to look at this long term to give us a feel. What is that telling us? All prices still remain below the 50 and 200 EMA, the Golden Cross. We certainly saw that happen, but that's in jeopardy. The MACDs are definitely declining and in negative territory. All that sentiment tells us it takes quite a bit of time to exit that negative sentiment. So we might see this sideways or declining prices going forward. The good news is the RSI for the overall New York Stock Exchange, again, high breadth of stock, so it's an important number to watch. That's racing to over sold area. It's around 34. Ultimately, there's only 38%, 39% of stocks that are trading above the 200 EMA. Big decline from several weeks ago of 71%. That was very encouraging. So all of the positive sentiment has been washed away in a matter of a couple of weeks. So this credit woe is of a concern, and it's a much bigger issue than what we've heard and seen this past week. We also look at our RSI table, and what do we take from that? We just try to see what sectors or market indices, that's what we track in this area, are oversold or overbought. And surprisingly enough, the NASDAQ is in, it's 59.9. It has a buy signal. The Twomey buy signal came out. We alerted our subscribers on trades. Take advantage of that this week. So that was a very encouraging development for the markets, but really not uh, not planned because you think the high tech sector is needing infusion of capital, these startups, et cetera. You think that that sector would be down, but what has happened is the fund managers are exiting anything that has to do with financials, credit, lending, banking, regional banks specifically, and just getting out of that sector and putting their money into CDs, bonds, treasuries, short term, 6 months, 3 months, 9 months, a year. And then also looking at the tech sector as an opportunity. And they've kind of driven that marketplace up. And one fuels the other, right? As the prices start to go up, more people jump into it. So that seems to be the safe haven now. Interestingly enough, the Dow Jones 36.4 for an RSI. It's getting there over sold conditions, and we saw that sector kind of hold its own last week, which is encouraging. But overall, everything else is in sell signals, and it is all buy signals for the short side, except for the Nasdaq. That short side is entered into a sell signal, Twomey sell signal, and then hence we've made changes accordingly. We also flipped TLT into TLTs as yields are pulling back, and that's there's some indications there that may have already reached its peak, but we will see because we've got the Fed probably increasing rates this week. So that's the relative strength index. As far as our sector table, again, we look at the 1 month as from top down as our kind of a snapshot of where money's going short term, and that has been information technology. The IT sector is green, communication services following next with some digital media and some other areas showing some positive increase. We also saw Meta take a big increase as it announced it did another round of layoffs. So they are clearly in the camp of saving money, cutting costs, following the Twitter blueprint, if you will, and it's really investors are saying, hey, that's good. You're showing discretion. So that's interesting. We'll see where that all shakes down. But everything else is negative. We've got utilities starting to raise the flag that it may be improving. So we've taken some positions there with our subscribers. The reason for that is simply put, as yields come down, the interest rate, the dividend, if you will, on utilities are more favorable. In other words, they'll be higher, and then more people buy the utilities, and then hence the price expands. So we're looking for that sector to improve if yields continue to stay low or retreat. Interestingly enough, looking at CDs, we've seen some now that the annual ones are growing. They were around 5.1, now up to 5.35. They are banks that, maybe more on a regional or lending sector side and hence need capital and are improving their rates. I don't know, but, you want to look at those carefully because, if you are going to enter a year CD, you want to make sure that bank there's no solvency risk, right? So you want to be careful there. Defensive sectors like healthcare, industrials, materials, all down. Energy has taken a tremendous beating this year. And then, we're seeing financials obviously at the bottom. No surprise on that one. We mentioned about moving over to the TLT as the bond yields are dropping. And then we do a little bit on what's the taxation and the worldwide economics, and we call them environmental analysis, how that impacts any trading. That's more of a long-term view versus a short-term view. Our four legs of tenant recession are, the inverted yield curve, which continues. That's bearish. 2 negative quarters of GDP. We haven't had that. We did last year. It's abated. So, but we do expect as the economy slows, GDP will slow. And then if layoffs kick off, we'll have probably a negative GDP. We're not in a prediction business. We're going to wait until the data tells us that. Rising unemployment, it's rising a little bit, but yet the environment is strong for workers, right? There are more people entering the workforce, and that's indicative of uh, subsidies coming off from the COVID. Uh, Also, too, with the fact that more people are getting second jobs out there, and retirees are trying to enter the workforce, and they're hitting in a lot of those lower paying service sector jobs because they want flexibility. So that's changing the ratios and adding some, changes in the unemployment numbers. But overall, it's bullish, right? So our tenets of recession, we really are the PMI below 50, so and the inverted yield curve, but we have the two other shoes to drop before we could say we're in a full blown recession, even though it all feels that way, right? Uh, so that's on the watch. We know there's a lag factor with interest rates. We really haven't, there's like that 4 to 6 month lag. So, if you look back where September was, it was 3%. If we look where July was, it was 2.25 to 2.5%. And we're hovering near 5 now. So, and with a 0.25 increase coming this week. So, I think ultimately this is a slow turn. We're this high, this long-term debt bonds that were bought up near 0% interest rate have no place to hide, and that's going to really put some dampers on the economy. And we're going to see where this all goes. But right now, it's not a very favorable position, right? So we also look from our charts. We're going to go right to the Nasdaq because that's really the headline of the week, right? If we look at this goes. I'm going to go to XLK. It's a little bit. It's the tech sector. We use that to trade more than the QQQs. And if we look back, and I'm going to pull this all the way back to this February 22, where the height was. We're well off that from the height. Oh, geez, I think that it was up around XLK anyways, a high of 175, and we closed this week at 140. 143, 144. So yeah, we're racing back, but we're not quite there. We've hit some nice inflection points. We're back to the February highs of 2023. Very surprising in this market. We broke through all our trend track lines. We're above the 9. We're above the 14 EMA. In addition to that, we're above the 50 EMA. These are our technical indicators that we use for our help in our buy and sell signals, as well as our stops if we are in a long position. And it's the 50 is now crossed above the 200, which is a bullish indicator. We call it the golden cross. I use the EMAs. Moving average is a little bit different scenario, but then that's the ones that are probably you hear about in the news. But overall, they're similar. And what we were looking at here is a buy signal that we got mid last week. We jumped in some positions to take advantage of that. It's too bad we're still not holding our AMD because that's reverse course and has went up to near 89. That would have been nice to have held throughout this debacle the last couple of weeks. But with that said, we've got other positions. We're taking advantage of this play. My belief and bias is that's going to be short-lived trade, but we don't trade on bias, right? So that's why we've issued this alert. So we're eclipsing that February high. Will we be able to get into the August highs of the last bear market? Hard to say, but there's a lot of volume, and it's coming into that side. We have to weather this. Friday's downturn was. We have to weather that and see if we can rebound, and if we do, there's a good chance that we can get back up to that August high. So that would be good. If we look at The SPY, the SPY is our S&P. That's what we use for proxy. If we go all the way back here to the February highs, we're still quite similar to the Nasdaq. We're well off the highs there, and I'm going to zoom in here. As you can tell, we're lower lows, lower highs, unlike the Nasdaq. In addition to that, we're well below the 200 EMA blue, the pink 50, and that has crossed negative into the death cross, the reverse of the golden cross, a very negative indicator. These are exponential moving averages now. Not the moving averages have not quite reflected this. We're below our 9 and 14 EMAs. It did try to break that 9 EMA, but we're all in. The sell signal is intact. Lower lows are intact. Lower highs are intact. And more importantly, we've pulled back from our lows of December, and we're reaching those once again. Will we get there? We may. We did have a reprieve at a 0.76 retracement and a little bit of a bounce, but the next stop after that technically would be those December lows. And beyond that, then we get into the lows of last year, which are on the horizon, and we'll have to be on the watch to see if the technicals weaken further. The MACD, the stochastics all indicate price decline coming short term. So that's where we're looking on the SPY. We look at the diamonds, which is, this is a little bit different scenario, even though it has pulled back quite a bit, right? Same kind of deal. We were going sideways most of the year. Here's December. If you can see my cursor, going sideways most of the time, right? And it broke that sideways move, and now we're declined again, lower lows, lower highs. We broke the December lows, right? And that didn't hold at all, and now we're heading to the beginning of the lows of last year, 2022. We're not there yet. If it, we expect it to flatten out here a little bit as everybody digests the market news and see where this credit risk is going to head. But the Dow Jones and Nasdaq seem to be the two places that have a little bit more strength, if there's going to be strength. The small caps, IWM, no surprise, a lot of these regional banks and other areas that really get affected, and this is quite a busy chart, but it's all said and done. They're heading to the lows of last year, 2022. We already are at the lows of December, and that indicates a little bit of a pause this week, but that indicates the overall weakness, and is a sign that the SPY could follow suit. We don't know, but it is definitely leading this downturn for sure. So that tells us clearly the issues that we're facing. But interesting enough, oil has taken, and you can look at this from two ways. Oil, this is the USO. Oil, this is the daily chart. I'm showing you all daily charts here, folks. Everything is down, down, down. They really took a huge look at this. This is our trend line. It broke through that earlier in the week and didn't look back. And the MACD's down into negative territory. Slope is down. Stochastics, are down. Very low levels, 6.5. The only thing is, if we look at the RSI is 27.9, indicates oversold indicator. What does that mean? First of all, oil sector coming way down. That precludes it says the economy is slowing down, less demand for oil will be out there. So the futures the oil really trades on futures, and what they're saying is, 6 months from now, we expect demand to really come down. You add to that, they opened up 3 of the 5 leases for the Alaskan oil reserves. That the government finally passed that, so that will bring on more supply. So that's factored in there somewhere, even though it's further out. But that is a bullish, or not bullish for prices, bullish for price reduction, let's say, because more supply. And then you had Saudi Arabia and Iran announcing reinstating diplomatic relations, which has been suspended for 7 years. And that also indicates a much more easing of, and maybe a potential increase of supply if Iran can get their oil out. It may also mean that they're just trying to establish a stronger price base or fix for oil, not fix in like negative connotation, but get prices as demand comes down, stabilize those prices so the bottom doesn't fall out. This whole Russia and Ukraine and that has not really changed. There's really no, China is going to meet with Putin. We're not really sure if that's to buy more oil or that's to try to broker another peace deal like it did with Saudi or in Iran. Who knows what's going to come out of that? But as China comes out of its malaise with COVID, and as Russia sells its oil to India, COVID, and in other areas, there's going to be still the need for Europe to get oil and natural gas. They're going to rely on the U.S. to do that. It's going to keep our prices up, but short term, we're going to wait before we re-enter that market. But with the RSI really low like this, there should be some type of knee-jerk rebound coming up, and we want to be able to play that potentially on a very short-term basis. So we're back to short-term trading. We're back to a bearish to neutral sentiment. We're also back to taking less risk in the market. We've parked a lot of money. We've told subscribers, get some money into CDs or treasuries, or that make sure you're in a high yield mutual fund at a good bank or a good trading institution. We use Schwab. Even though Schwab's market got hit, they seem to be in pretty good standing still on their numbers and their number of long-term bonds versus short-term and money and cash. So, but with that said, you do your own due diligence on where you're going to park your money. Overall, the credit risk, let's take a backseat view of this. Credit Suisse had problems in Europe. They did bail them out. Now, with some capital infusion, helps stem the tide. And then as of this morning, we heard that their USB is planning on making a bid that would be a valuation of Credit Suisse $7 billion less than what it was trading at. And it looks like that may be accepted. And if it does, hopefully that will stabilize that market over there in Europe and around the world. So that contagion is there. It's out there. They are being propped up by infusion of capital here in the U.S. The First Republic. Okay, let's take a look at that as a regional bank, as the kind of the next one on the radar. J.P. Morgan. Wells Fargo, a whole bunch of, the larger scale banks came in and infused them with $30 million worth of operating cash. And for a day or two, that kind of helped the markets were buoyant. They ran up and, the First Republic stock increased. They, came off the lows. And then by Friday, that all goodwill got washed out. We also had the Fed and the Treasury coming out and saying, look, all these fees that banks and then paying and charging or whatever in case of the next debacle, we're going to tap that and use that to make these long-term treasuries that are near 0%. If a company or a bank, or if a bank or an institution has to liquidate those, they'll use this fund of money to backstop that and give them par value versus having to sell at a discount. So in other words, you've heard me say before, if you got a bond at near 0% that's worth $100, and then you can buy a bond now for 5%. Which one are you going to buy? right? You're going to buy the one that gives you 5%. You're not going to, so the guy who's out there needs to get cash says, geez, I got this bond over here. It's 0.12%. Any takers, the only way you're going to buy that is at a steep discount, right? And even if you do, why would you? But that's what's happening. Those banks who are heavy, or those institutions or lending or criteria that are overweight those or have a higher percentage of those, and now we're not getting the infusion of capital, and the depositors take their money out and putting them into CDs and treasuries, they're stuck. And they need to, so if somehow the treasury is going to bail them out once again, they're saying it's not taxpayer dollars, but I think those fees really come from us, right? If banks have to charge higher fees to pay off, well, whatever, wherever that money's coming from, it's coming from somebody. That is, basically a bailout, right? We're not, par value. We're just kicking the can down the road. So I believe from that whole sentiment we just discussed, we got the credit risk is here. It's here for some time. We're going to have to watch it. And we're going to have to look at what are we going to do to invest in that. If we look at J.P. Morgan, let's take a look at J.P. Morgan. J.P. Morgan is this is the daily chart again, has pulled back from its highs this year, and then it's starting to abate, but it does not look overall very healthy, right? So that sector is struggling. Look at the XLB, the material sector. That is, you would think gold, and we're going to look at the gold miners, GDX. You think as money and inflation kind of it increases, right? It's kind of hard to say because yields are coming down, but inflation increasing because it's not going anywhere, as we saw by the data. That the materials would also have more value or cost more. But we're not seeing that. So that's, again, foretelling us that the economy is going to slow down. Look at GDX, the gold miners. That has been, usually will run up, and we do see that it is a buy signal. We do have a buy signal there. I did not issue that because, it doesn't seem like it has the strength based on, the MACD and based on the stochastics. We just didn't see the strength. We did see it cross above the 200 and the 50 EMA, and that really had given it some life. So Friday, huge increase there. So we're going to have to revisit that, look for a better entry. And if we see the weekly, I got to go to the weekly on that. As you can tell, we got up into a high April and May, right? And right before the bear market rally last year, and then in July and August that kicked off, and that certainly came down during that bear market rally. We're starting to see that we've got about 50%, almost a 50% retrace to those highs. Now there's definitely move afoot. We had a lot of buying in that sector. The gold miners, I look at that. Why? Because the GLD gold itself, gold miners tend to really outperform the GLD. But if we look at the GLD in the daily chart, bingo, really, we've gotten a tremendous run up. So that's a hedge, not for inflation. This is a hedge for banking issues. This is a hedge, and that's really what that's telling us. So that kind of wraps that all up into a bow of inflation, yields, and now people fearing the market. Gold is a fear trading vehicle, usually very volatile, very short-lived at times, so you got to be careful with that. TLT, that's the bonds. We talked about that. TLT, we're looking at the daily chart here. Overall, it's a fairly large sideways trade since November, mid-November. I mean, we've got a low of 100 and a high of, peaked at 110, if you will, but 108 to 100. It's basically sideways overall. And we've been kind of trading that in and out. This week it was a sideways, but very volatile week and a lot of volume as the yields changed, right? They're coming down, but we're still seeing some of these banks offering some good rates on CDs. There's some I mentioned earlier that are jumped for an annual yield of 5.35. So very interesting. We've got a buy signal on that. We did jump into that end of last week. It's favorable right now. How long we can trade that, time will tell. But right now we're seeing it move in the right direction. But rates are going to raise this week, so let's look at the short side of that, the TBT. And if you've read my newsletter, the TBT. This is a 200% leverage fund. Moves very rapidly. It goes up $1, we get two. If it goes down $1, we lose two. So, not there's we also have the vehicle to trade, 1-to-1 that we recommend. But that dropped dramatically, and then we're starting to see the ease of the sentiment is saying the Fed is going to ease, and then you're going to hear it. This is going to be prominent because the Fed probably will do the 0.25 increase. We saw, the Bank of England go 0.5 last week, even though they had reached, even during their debacle, because inflation still is a tough thing to break. And what's going to happen here is this: you're going to hear if the Fed goes up 0.25, that, and I'm not sure how Powell's going to address that. He may, say, inflation is still out there. We have concerns. The banking industry is solid and strong. So, but we're ready to intervene if something happens. If he says that latter point, I think investors and traders are going to view this as the Fed starting to weaken its position and its resolve. We do expect that the 6% is going to be the end of the, 5.5 to 6% should be the end of raising rates unless something dramatic happens one way or the other. And then we overall do sense that this credit risk is real. It's bigger than what we're seeing. It's impacting more and smaller banks as interest rate, as Fed rates increase, and there's other more safer vehicles to park and put your money, and depositors are pulling their money out, and that is real. That is no doubt real. So we're going to hear all the pundits say the Fed needs to pause. The Fed will also need to plan for a reduction of rates by the end of year. Wow, what a total switch that would be, right? Overall, we're seeing the economy slow. We're seeing all the manufacturing index. We're seeing credit, credit rates. We're seeing people's credit cards balloon. We're starting to see people late on payments. There's all types of things hitting the books that are, delinquency in cars, all kinds of things that generally mean the economy is slowing down and people are just having to struggle to pay all their bills. What does that mean for us? That means that we're going to have to be careful in our trading. We're going to be really, look at potential ways to let's see if we have SJB here. Look at ways that we can take advantage of the credit risk that's out there. SJB is really a way to trade if credit gets tight and if their junk bonds start to get impacted. That is showing some good signs. There's been a buy signal in that for some time. It doesn't really move too much to make it worthwhile trading at times, because if we don't see junk bonds falter, it really doesn't, you're not going to get much money out of it, and you have to put a lot into it, and it's not worth the risk. But with that said, we are looking at that as a potential investment vehicle to hold over a period of time. And then if we get a favorable entry, we may take a look at that. So we're looking at GDX, we're looking at SJB for the credit risk issues. We're also looking at TLT and trying to maintain that, but we're going to keep an eye on that really close. And then we're looking at some of the tech sector plays, and we also view that as a short-lived trade. If any of these extend and go out for a longer trend, that's what we're looking for. We're always looking for that longer trend. We don't want to buy at the bottom. We don't want to sell at the top. We want to get a long-term trend and stay in it and go in long and heavy. It's still a very tenuous market. We say extreme caution on any trades, long or short. And then I would recommend that you put in your stops and make them Follow our principle on a one third stop techniques. When you're in between buy and sell signals on our alerts, we always say is try to get in on them as close to those alerts as possible. Yes, you can still participate later, but you don't put as much at risk because we may be halfway or three quarters through our trend range, and then some of our stops kick off. So that's the market report for March 19th, 2023. Extreme caution. It'll be an interesting week with the Fed news coming out. Probably not a lot of opportunity to trade, but a lot of opportunity for volatility. And that's something that you have to watch. That could be in your favor if you're doing some short-term trading. I'm James Twomey, and this is the Twomey Stock Market Report. Welcome and have a great week ahead. And don't forget, go to TwoMeStocks.com. That's the number 2, MEStocks.com for all this information. It's on the front of our webpage. And sign up for our trade alerts. Participate in that. Never miss a trade. Never miss an opportunity to make some money. And that's why we're here. You only trade stocks if you want to make money. Everything else is secondary. Right now, you have plenty of places to park your cash for the next 6 months to a year and get a great yield and great return. Markets are not going to really do much different than what we've seen the past 18 months. So why risk? And if you are going to risk, come to us. We'll help you make some money. I'm James Twomey. Enjoy your weekend.